back to my channel. So today's video is all about dividend investments with 5 stocks and ETFs. So I'll provide a high-level breakdown of each dividend play with angles that add depth and value. Now these aren't just tickers, they're income-producing strategies as stocks. So for the return on investment, they are pretty high-quality selections. Oh, and y'all, it is storming tonight out here in Texas, so if y'all randomly hear rain or thunder in this video, forgive me. I'll try to reduce the background noise as much as possible, but if y'all do hear noise, that's what it is. So let's just go ahead and dive right into it. The first security that I want to discuss is going to be JP Morgan's Equity Premium ETF, and their ticker symbol is JEPI. So I'm going to go ahead and scroll past the derivative income information, past the chart as well, and we're going to scroll past the fund profile, and all the way down past the holdings. Of course, we know that Visa, MasterCard, Train, and NVIDIA are the top 4 holdings in this ETF, but we're going to look past that as well, and we're going to go ahead and take a look at distributions and yields. Now, why this ETF stands out is that, of course, it pays monthly. We can see the frequency here, and we also see that the distribution yield is at a 7.79% with built-in options income. Now, the structure is that JEPI isn't your typical dividend ETF because it sells covered calls on the S&P to generate premium income, and then that cash is passed off to shareholders every single month. So what that means is that it's a hybrid of a dividend ETF and an options income strategy wrapped in one single ticker. So essentially, there's no trading needed. I mean, you could trade this ETF if you just had the desire to do so, but you wouldn't have to reap the benefits of this one. Now, why it's so popular is that investors love it for the consistency of cash flow. I've even heard some say that they use it to supplement income without selling whole shares. So that's one good advantage to this. Now on this bar graph right here, we can see the dividend income, at least from February of 2025, March, April, and May, and of course we see it increasing. So again, all good signs of this specific ETF being a quality investment. Now I will say there are mixed reviews on if some people believe it's a buy and hold. I personally believe it's not a bad investment at all if you're just dividend chasing. I do think this ETF provides a good distribution yield of income, and of course that's for the trailing 12 months at TTM. So I'm going to go ahead and scroll back up to the top. We're going to take a look at the second one, which is going to be Schwab's ETF. So I'm going to type in the ticker SCHD here. And of course, we see it pulled up. So once again, I'm going to go ahead and scroll past all this information that we see here for the charting profile. Holdings, of course, we see the top holdings here as well, are going to be things like Texas Instruments, Lockheed Martin, Chevron. And these companies raise their dividends year over year, so their YOY is pretty solid. But going back down to it here on the chart, we can see that Schwab's distribution yield is at a 4.03%. Now with Schwab, I will say this specific ETF is built for dividend growth, not just as a high yield. The real power is within its dividend compounding. Now Schwab has an expense ratio at 0.06%, making it one of the cheapest dividend ETFs on the market as far as being reliable and trustworthy, which is why you always tend to hear really good things about investing in this ETF. Now, the reason why I particularly like it is that Schwab doesn't chase hype. It sticks to quality metrics like return on equity, even dividend consistency, and strong balance sheets. So they closely monitor companies' fundamentals. They are not on a whim resizing their structure, which is good. So if the numbers don't add up, they're not rebalancing positions. It's just not going to happen. So the use case angle for this is that you won't get rich overnight with this ETF, but Schwab is the dividend portfolio you build once and collect on for decades. And again, that's credited back to the consistency. Okay, so scrolling back up, the third one on the list is going to be SKT. So I'm going to go back up here to the top and I will type in SKT here. And of course, we see the REIT. Now, in my opinion, this is an underrated stock. Now, this is a retail REIT with quarterly payouts. So let me scroll down so y'all can see the numbers. We're going to go down here to dividends. Now, for those who are unaware, the business model for SKT is that it owns and operates outlet malls with tenants like Nike and Under Armour. So essentially, they provide the lease space for some of your favorite stores in the mall. Now, we can see their dividend yield is at 3.75%. And I can say that the dividend has been increasing post-2020 recovery. Now, we all know what happened in 2020. And of course, there was a lot of reluctancy and uncertainty at the time, but SKT did bounce back. And for those of you who have been following me for a while, y'all have heard me talk about SKT plenty of times before. Now, the growth twist with this stock is that, of course, e-commerce hasn't slowed down outlet shopping. If anything, SKT has found its niche. They have low overhead, they also offer destination shopping, and they have very strategic locations, some here in Texas, Georgia, and I believe they have a few locations in North Carolina as well. Now, another advantage of this stock is the REIT tax benefit. So, as a REIT, it must pay out 90% of taxable income, which makes it a consistent income producer for shareholders. Now, a good use case angle for this stock is if you've ever wanted to get into real estate without having to manage people or property. SKT is like you're getting paid every quarter just for owning the stock without having to manage any of the tenants. So, in a way, it's like a real estate investment without the headache that may be presented with having to deal with people. So that's everything for SKT. Let me scroll back up and we're going to go ahead and take a look at AVGO. I'm going to type that in here and we're going to go ahead and scroll down again to the dividend section here. All right, so with AVGO, at times what surprises people is that it is in the tech industry with a high cash flow and generous dividends. And we can see their dividend yield is under 2% at a 1.03%, but the growth is the real story with this stock. Their dividend has skyrocketed more than 300% in the last 5 years alone. So that's not an average growth rate. Now, the business model is semiconductors plus enterprise software, which of course equals high margin revenue. Just those two words by themselves, semiconductors and software, yeah, definitely high revenue, no question. Now, they do have a sustainable competitive advantage that allows them to maintain profitability and market share over the long term, and that's because Broadcom powers everything from smartphones to data centers, so without doubt, they've certainly got pricing power. Now, their growth plus income mix, you don't usually get a tech stock that pays a solid dividend and grows at the rate like AVGO. That 300% growth in the last 5 years is significant. That's a pretty big deal. Now, a good use case angle is that AVGO is the rare tech stock that boosts your portfolio in two key ways, through growth and cash. So it's one to keep in mind if you haven't fully studied up on it. All right, last but not least, we're going to go ahead and take a look at Main Street Capital. I'm going to scroll back up and we're going to type that in here, Main, and I'm going to scroll down to the dividend section once again, right here. Okay, so with Main Street Capital, what makes them different is that they provide monthly payouts from small business lending that they service. Now, they are a BDC, which is a business development company, so that means that they provide debt and equity capital to small and mid-sized private businesses. Now, with their monthly dividend at almost 6% at a 5.53%, with a bonus dividend occasionally paid on top, so every now and then they'll throw in a little extra dividend payment to investors. So that's always a small benefit. Now, in reference to diversification, the interesting thing about Main Street Capital is that you're essentially backing a portfolio of private businesses, as mentioned. However, you're doing it without being an angel investor or a venture capitalist. So in reality, owning this stock is like you're an investor on top of not being a VC investor. So I hope that makes sense. Now, the tax structure, BDCs are required to distribute most of their income, which is why their yields are higher than typical stocks. So it's beneficial in essence since you get the advantage of that with this investment. Now, a good use case angle is that Main gives you access to cash flow from small businesses with none of the operational stress. And it's privatized, so that adds another layer of strategic leverage if you play it right. So you just have to know what you're doing when you're balancing your portfolio. So yeah, y'all, these are the 5 dividend paying investments that I think are quality and offer pretty good returns. I know this was a really quick video, so I just wanted to provide the information. Y'all let me know what y'all think. But if y'all want a more detailed breakdown of any of the content, again, just make sure you let me know in the comment section. And with that, that'll pretty much do it for this video. If you found this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.